Well, good evening, ladies and gentlemen, and welcome to BAFTA. My name is Mike Southon. I'm your host and moderator for this evening. I'm an entrepreneur, built and sold companies, done various stuff. I've been writing a column in the Financial Times for the last 4 years. Anyway, so what we're going to do is we're going to talk about some stuff that's happening at the moment, changes in the tax laws and so on, and we're going to go through a few little scenarios for you, and then I'm going to do a little bit on entrepreneurship right at the end. And then we're going to drink heavily, and hopefully tomorrow we'll all be at work. But anyway, we'll see. Well, first up, we're going to have a moderated panel discussion, and you probably know a bunch of people from the channel. So we have, and it's actually in the order they are up there, in case you don't know who it is. So we've got Darlene Hart, who's CEO of US Tax and Financial. So a quick wave to the audience, Darlene. Hello, yes. Give her a round of applause. Excellent. Then Gregory Dean, who is the tax director, it says here. Fantastic. So give him a round, please. And David Treitel, another tax director. Quick wave. And Andrew Aldridge, Director of International Tax Planning. And remember, this is your last line of defense against the IRS, so be nice to them. There we go. So we're going to ask some questions, but I do warn the panel in advance that I am an entrepreneur, so my attention span is about that big. So if my eyes begin to glaze over, what I'll do is I've got my magic clipboard here, which is the only device I have to keep everything to time. So if I think it's getting a bit sort of, heavy, I'll show you the clipboard. If it gets really bad, I'll just hit you with it. Probably the simplest thing. So, well let's...
We could leave now.
Oh, no, please stay here. No, the fun hasn't started yet, honestly,
Okay.
Andrew. It's going to be fine, trust me. Trust me. Okay, so I'll ask the first question, and it's really what is new for 2012. So, let's start with you, Darlene. A little bit of background on an American's reporting responsibility for US taxes when living abroad.
Okay. As you all may or may not know, I would assume quite a few of you do know that Americans living abroad are subject to U.S. tax on a worldwide basis no matter where they live. That's the cost of that little blue passport. And even if you don't have a little blue passport, if you are an American citizen, you are still subject to U.S. tax. Because remember, I would say less than 10% of the Americans in the United States actually own a passport. So U.S. citizens, no matter where you live, are subject to U.S. tax on a worldwide basis. And back in 1948, the United States government set up some type of a voluntary disclosure program for anybody who kind of forgot to mention their income or whatever, got behind on their tax returns. So voluntary disclosure is not something new. It's something that's been going on for years. Now you've got to remember the U.S. government needs money. Just like Greece, just like every other country in the world, we need money. We have to support these wars that we have all over the place. But the main issue is the U.S. government needs money, just like every other government. There are 7 million Americans who live outside the United States. Do you know how many of them actually file returns? About 460,000. Ouch. So if the U.S. government is not increasing their highest tax rate, which they haven't done, our highest tax rate is at the 35% bracket, and it's been there since, 2003, I think? So we've had our highest tax bracket at 35%, and you don't hit that until you have $360,000 of taxable income. That's after all of your deductions. Now, if you're not going to increase your tax rates, where are you going to get your money? Well, if you got 6.5 million Americans who are not filing returns, don't you think you'd kind of start there? So this whole issue with Americans with foreign bank accounts and UBS and LGT and the huge lawsuit that the U.S. government was very successful with going after UBS, a lot of information was passed forward to the United States government because all of those clients were asked to give the name of their bank, how did they set up their bank account, how did they find out how to set up a bank account, who were their lawyers, who were their bankers, how many times did they meet with their bankers, all kinds of information. And all of that information, people came forward and just gave it to the United States government. So as a result of that, another 11 banks were actually, are currently under indictment by the Department of Justice. So at the end of the day, the U.S. government is looking for all of those, not just Americans living in the United States who kind of forgot to mention their foreign bank accounts, but also all of those Americans who live abroad. Now, under this last voluntary disclosure program, 2009 was a good one, 2011 was another good one, 33,000 people came forward. They raised $2 billion in revenues from 33,000 people. That's not a bad rate of return. So just think what the IRS is looking for here. And this is why FATCA is being introduced. the Foreign Account Tax Compliance Act. And I think Greg is going to tell you a bit more about that.
Anybody feeling just slightly guilty or not? No, probably not. No, Uncle Sam needs you to pay your taxes. So it's voluntary disclosure, so if I understand the technicalities, you can sort of say, oh, I volunteer to give some money.
Yeah.
Otherwise, Uncle Sam is going to come looking for you.
Yeah, well,
Can I just give you some updated numbers? Just numbers?
Yeah,
Yeah.
sure,
Because the
go for
IRS updated these just in the last week. And we have, from the 2009 disclosure program, they said they raised $3.4 billion.
Oh, really?
$3.4 billion. From the 2011 one, where they haven't settled any of those as yet, not a single one. They've already received $1 billion in cash in advance payments from people that came in. So they've got $4.4 billion so far from voluntary disclosure, and there's more to come.
Wow. Well, let me ask Greg. Let's talk about what has changed in 2012 and what the IRS is doing to actually enforce these obligations.
What's changed? I mean, there's been a few developments since '09. I think the UBS case was, first of all, a perfect storm for the United States. You had some very sort of shady actions by a very large bank involving Americans living in the U.S. And it created, and I think what Darlene's mentioning is, 15,000 people providing information, and it gave them a pretty good sight of how things are done outside the United States, how offshore banking works. And so the big development that happened in 2010 was the passing of FATCA, the Foreign Account Tax Compliance Act. FATCA is kind of a super reporting, and what it's done, it's made your banker, it's made your hedge fund manager, it's made your asset manager essentially a reporting agent for the IRS. They'd already experimented with this in 2000 under the qualified intermediary rules that said a bank must determine if you have a U.S. citizen or a non-U.S. citizen, and it wasn't direct reporting, it was indirect reporting, and now under FATCA you're going to have essentially very, very direct reporting of all your accounts. And in fact, we have one of our colleagues here from our Zurich office just got a letter just this week from his Swiss bank, which introduces him and it starts to explain to him what FATCA is going to do. And it says, as of January 1, 2000, we would like to inform you of the implications of FATCA for your client relationship with our bank. And what it says is that the IRS wishes to obtain information about any and all accounts and deposits held by U.S. tax subjects worldwide. So there you go. This Swiss bank is now going to become an agent for the U.S. government. It's going to have to report on Mike's account with them. It's going to have to send in annually a disclosure that says here's what his account balances were, here's how much interest he earned in the account, et cetera, et cetera. So that's a huge change. What that's meant from a market standpoint, certainly in Switzerland, is you have certain banks saying, no thank you, U.S. client, please leave, here you go, where can we send you your money? And you have other banks that are saying, okay, fine, we're going to get systems ramped up so we can comply with this and actually do the reporting that's necessary. But you're going to, I think the big change is that this gray world of being able to find a bank that's not going to, and I think just last week or the last couple of weeks, to correct Darlene a little bit, there's not 11 banks under indictment. There's 11 banks under investigation currently, Swiss banks. One of them, Weglin, has been indicted. And one of the things that, what happened is we had Mr. Hummler, the head of Weglin. First of all, they closed a Miami office that they had, and their letter to shareholders said, bye-bye USA. And then he said the U.S. government were tax imperialists. These were his statements. And now his bank is under indictment. They've actually had to sell all the non-U.S. portion. This is the oldest bank in Switzerland, has now sold itself off to another bank, a competitor, and left only the U.S. accounts inside this bank as a protective measure for their other assets. So this is what you're getting. The idea of gray banks, of being able to do this sort of banking in areas where you're not going to have the reporting is becoming, first of all, difficult, and secondly, obviously, it's dangerous. As a friend of mine used to say, do you want to leave your money in the banker of Lower Pismoldia? Probably not. You may never see it anyways.
The Bank of Athens. Well, so the message I'm getting is that if you don't comply, you better get complying pretty soon. So let me ask David, what would be 5 things that a US national could do to comply?
I was thinking about what 5 things people should do, that I should paraphrase Mr. Blair, our former Prime Minister, and talk about the 5 things you should do is see US tax, see US tax, see US tax, etc. But if you're not going to be doing that one, before I answer that one, I'm going to explain that for anyone that does not realise that Greg sitting next to me is based in an office in Geneva, and share with you a small secret about the letter he's just read you, addressed to a colleague of ours in one of our offices in Switzerland, is that's from a post office bank. It's not from a great big international bank. It's from a local post office bank in Switzerland that's telling him that we need to inform the IRS about your bank accounts. And here, based in London, we see people all the time, and we're seeing probably still 20 to 30 people every single week who have never ever filed a tax return in America, had no idea they were supposed to do so. Many of them were born in the UK, many came here as college or as children or for marriage or for work, and never had any idea they were supposed to file returns. And when we see these people today, they have 5 very simple choices ahead of them. And the 5 choices they have ahead of them are really quite easy. They, of course, can do nothing at all, fill no forms in, not tell the IRS they exist, never file a tax return. That's reasonably high risk, because obviously one day the IRS may find them, one day they may renew their passport and the IRS finds them that way, or they may register the birth of a child with the embassy, or they may visit the United States and get held up at the border. So doing nothing at all is not the most wonderful thing. What some people are doing when they discover they're supposed to file is, of course, just starting this year and not bothering with the past. And that's not a bad answer. You file some forms, the government starts getting some forms, perhaps they'll never ask again. And again, it's not too bad an answer. The problem I've got these days, if you just file going forward and hope they don't ask about the past, is that the IRS are quite likely to say that doing nothing about the past once you know you're supposed to file implies that you are willfully not filing for the past. And the penalties for willfully not filing are horrendous, quickly running into the several $1 million range.
And David, excuse me on this. The real lesson that we've learned in Switzerland, since we've been doing a lot of work there, is the banks are being asked, you know, under these 11 banks that indictment, not what did you say? Investigation. Sorry, investigation. The real lesson with regards to all of those banks, they are complying, and they are handing names out, and the IRS is asking the Swiss federal tax authorities to give them data on their clients, their American clients, from 2002 to 2010. So it's history, and you can't change your history. You can take your money out of the bank today and change it, but it's not going to, you know, it's definitely not going to do anything about your history. Now, all of those UBS clients whose names were handed out by UBS to the U.S. authorities, those names were people from history. They were not current UBS clients. They were clients who were no longer UBS clients for years. They were clients somewhere between the year 2002 and the year 2010. And Credit Suisse is doing the exact same thing. And so is Julius Baer. You know, because we see the letters that the banks are, you know, that the Swiss federal tax authorities are sending to the clients and asking for this type of information.
Darlene, I'm now scared, even though I haven't got any money in Switzerland. So come on, David, what do we do to comply? And tell us about the form 8938, which we're dying to find out about.
Got to all 5 things. We can do nothing at all. We can file going forward. And as you said, the UK government signed an agreement with the IRS on the 8th of this month, saying that they will start sending names, addresses and account balances to the IRS automatically. If you do nothing, that's not a great idea. Filing going forward, I think you may be found. I think it's high risk. You can quietly file, which effectively means you fill all the forms in for as many years as you think is right, stick them in the mail and hope the IRS don't ask questions. And again, that for some people is the right answer, but you'd probably want to do some maths and work out what the possible exposure is to penalties before you rush to stick things in the mail. The alternative, and Darlene said this earlier, is to use the IRS's traditional voluntary disclosure program, which has been open since 1948, and that implies sending in, obviously filling in returns for how many years are appropriate, 6 years typically, calculating what your exposure is in terms of penalties, sending those returns to the IRS Criminal Investigations Division, because that's what voluntary disclosure requires, disclosing and explaining your position. And they may choose not to criminally prosecute you. There's no reason why they would necessarily. But it sounds pretty scary. And if you're not going down the doing nothing route, the filing going forwards, sending things quietly in the mail, the traditional voluntary disclosure, the fifth alternative today, is to use the IRS voluntary disclosure program just launched this year, which requires filling in 8 years' worth of tax returns, paying any tax you owe and some penalties on the tax, but also sending the IRS a very nice donation of 27.5% of the value of the assets you have outside America, which is a very, very large penalty, and for many people would bankrupt them. And it's not an enjoyable choice, but that's the 5 choices you have today. Now, having said that, America has got probably the simplest tax system in the world. It's quite easy. Darlene mentioned it earlier. It's worldwide. It's forever. In addition, I don't think that's difficult. So we've got a really simple tax system, and it requires a whole bunch of income tax returns. And for those of them who have done in the past, they may be familiar with the FBAR, which discloses bank accounts. We have a nice new form, this 8938 form, which requires that you disclose vast amounts more of financial assets. For most people outside America, you don't have to file the form unless you've got at least $200,000 worth of money stuffed in a bank account, pension plan, shares, and other investments. But it's a whole bunch more reporting than ever before, simply because America wants to know more about Americans abroad and how much money they have so they can raise tax to help pay off some of this lovely national debt.
Now that we've scared the living bejesus out of most of you, the real issue that the IRS has actually given a serious break, and they're treating Americans living abroad much different than they're treating Americans living in the United States who have all those foreign assets abroad. They're actually giving a break for people who actually live and pay taxes in their local country. And they will seriously consider, under reasonable cause, abating all penalties. Okay, not interest, but all penalties. But now think about it. Your top tax rate here in England is at the 50% bracket. If our top tax rate is 35%, how much additional tax you think you're going to pay? Okay, you should have more than enough foreign tax credits to cover your U.S. tax liability if you're actually filing and paying tax here. Depends on if you're not domiciled, if you're paying your $30,000, what assets you have offshore. There's a lot of issues to consider. But, I mean, think about it, guys. The top tax rate here is 50%. Our top tax rate in the States is 35%. You don't even hit that until you have $360,000 of taxable income. And what do you hit the 50% bracket at, what, 100,000 pounds or 150? So.
And the Form 8938, which I've got here, that is the form you fill in to disclose this stuff.
Along with your non-US financial assets to the IRS. So you write down the amount of money you have in the bank, the value of shares you've got, the value of interests in partnerships, interest in pension plans, interests in trusts. It's a pretty comprehensive form.
Now, I don't know if any of you have any questions. Normally I say let's have some questions, and I say explain who you are and what your challenge is. I think what you may prefer to do is to go and visit US Tax Financial and discuss it privately. Though I'm actually, hang on, I'm getting my earpiece. I've got a question. Actually, it's a question for Andrew. It's a question from Mr. McCartney from St. John's Wood. He says he's married an American girl, and it's all gone terribly well, but he feels now, having heard the discussion, that perhaps he should have done some prenup stuff to stop the IRS getting all of his money. So what would your advice be to this Mr. McCartney from St. John's Wood?
If you'd come to me earlier, I would have said fall in love with somebody that isn't an American. Now that he's...
Wait a minute.
No, I've only got one thing to say to that. Heather Mills McCartney. Didn't work out. So the British girl, she's gone back to the American girl. It's going better for him. What would you advise?
Love doesn't conquer taxes, necessarily. The biggest problem you have with married couples is they like to commingle their assets. He owns something, he wants to give it to his wife. She owns something, she wants to give it to her husband. The problem when you've got what I call a mixed marriage is if the Brit gives assets to the American, she has to file a report with the IRS and says, I just got a bunch of money. And she doesn't have to pay any tax on it, but she has to file the report. If she doesn't, there's about a 35% penalty just for not telling the government that you got an asset. If the American gives assets to the Brit, it's a gift and it's subject to gift tax. Now we have an annual exclusion. We can give away a little over $100,000 a year, and we have a lifetime exclusion, which is this year $5 million. So you can do a lot of planning, but you still have to file the returns. And the other problem we've got is this $5 million, which, like I said, sounds like a large amount, is probably going to go down to $1 million in 2013. At least we've got no action from Congress yet. So moving assets back and forth you can't do it freely. If you can plan about your asset ownership, what you want to do is have the Brit own the assets that are not U.S. tax friendly. The obvious one, it's kind of a simple one, is your residence. When you sell your primary residence in the UK, you don't pay any tax on the gain. In the US, we only get to exclude $250,000 of gain. So why pay tax on a house if you don't have to? Mortgages, you have to watch out for mortgages. If an American borrows money in a foreign currency, when they repay the mortgage, there's normally a foreign exchange gain or loss on that repayment based in dollar terms. We get taxed on the gain, we get no benefit for the loss. Mutual funds, collective investments, insurance wrappers, bond wrappers, all of these investments work in the UK. They're horrifically taxed in the US. The American can invest in individual stocks, individual bonds, real estate. So if you can look at the marriage unit and their investment as a total, not one each, spread it out between the two. Put the bad American investments in the Brits' name, the good investments in the Americans' name.
So the message is, if you get married, you mingle stuff, but not your assets.
Yeah.
And what was that horrible phrase? You know, love conquers everything except tax. Very scary. Well, there is space for probably one question. I'm guessing, a lady down here. And you don't have to say who you are. Is it your friend has a problem with their tax, possibly? Or not you, clearly. So you have a question, ma'am, yeah.
I just wondered if the panel could clarify exactly what's happening in the UK as far as FATCA and how the US government is getting UK banks to actually disclose this information.
Did everybody hear the question? It was what's happening about FATCA and what is the UK doing to make sure that the IRS gets the information it so richly deserves?
Let me explain. I've been speaking today at a conference about FATCA and spending the entire day hearing about nothing but FATCA, and I'm speaking tomorrow at the same conference. And FATCA is a fascinating subject because for those of you who know very little about it, the United States issued 389 pages of draft proposed regulations earlier this month. And those proposed regulations are so difficult to understand and work and become workable by the global financial community. Along with that, the governments of the United Kingdom, the Kingdom of Spain, Italy, France, and the United States entered into a joint agreement saying that they will agree to share information about Americans. So the UK government will have to change UK legislation to comply so that the UK data protection rules, European Union data protection rules, are not breached. And similarly, the United States will have to change the laws in Delaware so that Delaware starts sending the names of owners of US corporations to the United Kingdom. Is that going to happen? Is either country actually going to change their domestic law in any hurry at all within the next 1, 2, 3, 4 years? I would doubt we're going to see very much movement. There's other things for Congress to worry about in America. There's an election this year. I think there'll be a very, very slow burn on the UK and FATCA.
Okay, well, I think we covered topic one, which was, as you put it, scare the bejesus out of everybody. So, and I think the message is, come and have a chat with the experts. So a round of applause for our experts here. Thank you. Now,